Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. T+1, if I can call it that, or a B+1, budget plus one. Yesterday was a Sunday, the union budget. And of course, we got you all the details, all the highlights through the course of the day. We're coming to you from the CNBC-TV18 News studios. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, hi, morning.
Hi, good morning. And the question is, will the markets wake up to a massive budget hangover after yesterday's violent flush out?
Well, that's right. And, it's Monday, remember, guys?
Yeah, there's a whole full week ahead of us.
You woke up this morning and you wanted to prep for the show. Looking at the rates, you're wondering what's happening. There's no overnight action from the US markets or any of the global markets. They said, oh, man, we were working yesterday. So realigning ourselves and get set for a big week.
Yeah, that's what a working Sunday does to you, right? I mean, it sort of throws you off completely. But let's just take it from where we picked up from yesterday, right? I think that's essentially where we are at in that sense, right? And I want to start, of course, with just a couple of lines on the budget before I go any further, because I think it's still very much the focal point, very much the focus area. And typically, what happens many times is a day or 2 days later, people will start to move on, but also, I mean, what seemed like a shock as soon as it happened does not seem like a shock. I mean, there's, of course, human behavior at work as well. I mean, that STT hike, I think overshadowed everything else. It was a pretty pragmatic budget, focused on the long term, staying the course, did not let the fisc slip, etc., etc. But I think the one thing which markets were expecting, along with everything else, which is the pragmatism, given that it's a tough place that we find ourselves in. The budget is tight, not very much money, not very much leeway to spend in that sense. So all of that was fine, but I think what was expected was some help on the equity taxation front, perhaps at the margin. But what was absolutely not expected was it going in the reverse direction, which is the STT hike. And that's why I'm saying that pragmatism in the budget perhaps overshadowed, at least yesterday. But let's pick it up from there, right? Now, the numbers are all on your screen. FY27 budget spending growth and capex has been a focal point. So defense 18%, railway 10%, power capex up about 18%. And these are healthy, good, strong numbers in that sense. The one thing I picked up from conversations with many across the board, post-markets, etc. as well, is that the data center investment could be a big thing. It's a 21-year tax holiday. We'll talk more about this. I mean, in terms of what this can do, what this could mean for FDI, large amounts of FDI to come in. And remember, with something like this, 3 or 4 players globally control 70-80% of the data center market. So you're not talking to hundreds of companies. But these companies have the ability to pump in, $100-200 billion. So this is something which came out as a piece of, positive, something new, unambiguously, and also which, of course, addresses what's happening with the big AI boom globally. Now, STT on F&O, of course, the biggest surprise, by far, as I said, negative surprise. No offset from capital gains tax. However, the mood, I don't need to repeat that. And on the back of it, and remember, yesterday, FPIs were not there in the market. It was just us, right? But because FPIs were not there and there today, we'll see if there is some selling which starts to come through. If you look at the cash market numbers, the local investors also sold. I would imagine, that's, of course, also on the back of this disappointment, but also perhaps a little bit of anticipation of what FIs may do today, FPIs may do today. So that's where we kind of find ourselves at. Now, the other thing which was not there yesterday, along with the international markets and FPIs, was bond and rupee markets. So bond markets will open, rupee markets will open, and watch it at 9 o'clock. And I feel it's possible, bond deals perhaps inch up at open, 5, 6, 7 basis points, and perhaps the rupee could be under a little bit of pressure as well. So, again, something to watch out for. The worry here, especially on the bond market front, is the gross borrowing number, which is, of course, higher than what markets expected. So, I think 915 equity, but I think before that, both bond yields and equities should be in focus as well. Just a few other things. Auto sales numbers for the month of January are strong, and we'll get more details company-wise in a little bit from now. But this is good to see. Gold and silver prices, Manisha tells us, are, because remember, the last close, of course, was on Friday. International close was on Friday. We were trading here yesterday. And in Asia this morning, gold and silver prices are lower. But I don't think there is a big correction after yesterday's big sell-off in gold and silver prices, because if you look at parity prices in rupee terms, the market here closed lower than where international prices closed on Friday. So this morning, as we opened the ETFs and the trading on physical front, the MCX market, I don't think there is a big down leg, despite the fact that, in spite of the fact that gold and silver internationally is lower once again. Later in the week, I mean, there's the RBI decision, which will come through, and I think it's largely expected to be on hold. But I think it'll be interesting to see, especially because the RBI is expected to be a net buyer of bonds this year, and we'll have to watch their views on rupee, etc. So commentary, I guess, more important than the action where they expected to stand pat. I'll just tie in the levels here and wrap it up. So Nifty is back in the channel, big intraday swing, right? So we're back in the channel, and the downward sloping channel, we broke above it on the upside. And we are, by the way, we are now closer to the lower end. It's a big whiplash yesterday, and we are now closer to the lower end and then to the upper end. The channel support is 24,650. We left off at 24,825. Let's move on. Let's put the levels up, please. And 24,650 is the first support. If 24,650 breaks, which is the channel support, the August low comes into view, which is, I think, 24,337. Yeah, 24,337 is the next support, if you can put that up as well. And so these are on the downside levels to watch. On the upside, the resistance is 25,170. And I think that's where we find ourselves at. Remember, for financials, for the Nifty Bank, etc., I'm not putting out levels. It'll also depend in a large bit on the bond deals and how they open up, because it'll impact treasury gains and treasury. I mean, on the treasury front, it's going to be a big mover this quarter. So we'll sort of get to it as we go along. GIFT Nifty will come up on your screen as we open up. And we'll give you a quick sense of where we are starting. It's 10 points, so neither here nor there in terms of very, very measured kind of start. I guess still watching for what foreigners will do, because that we'll only find out by about 9:15 or so. And of course, before that, the bond and rupee market start. Positioning and how does it look? Nigel, over to you.
Well, one quick point. The Nifty ended down close on 2% yesterday, which was budget day. And this was as bad as what we saw in 2020 when the Nifty ended down 2.4%. But guess what? 1 week later, we were actually up 3.5% before COVID took over. And that's when we had that big sell-off out there. So that's the data point that I'm clutching onto, that maybe, in fact, yesterday we did position ourselves for a manic Monday, but may not happen. Let's see how that goes. Well, looking at the Nifty intraday chart, clearly, yesterday the domestic players were definitely bracing for a very, very bad Monday. So we'll see how that goes, because there was a lot of selling that we saw from the DIs itself. DIs sold close to around 700 crores. That's something that we haven't seen. And FIs were virtually absent in trade. But in the futures market, on index futures, there were short positions that were added close to 9,500 contracts, with their short positioning at around 88%. I was looking at the F&O data, and the clients on stock futures, they unwound some long positions. Close to around 45,000 long contracts is what they unwound. And that's something I haven't seen in a while. So there was some unwinding of longs that we saw from the domestic participants, coupled with selling in the cash market. How does the positioning look on index futures now? Well, clients, they are net long, 1.3 lakh contracts on the long side, while the FIs, they are moving towards extreme levels at around 2 lakh contracts on the short side. So that's one data point. When the FIs are so aggressively net short, and you have the markets that have already corrected, in a jiffy, we have corrected what, 26,200 to around 24,800. That's a sharp correction that we have seen. The other technical factor that I'm looking at is the way we have stretched in terms of the PCR data, because the PCR is at around 0.6 or thereabouts, which is the lower end, and normally this technical indicator indicates a bit of a bounce. So the PCR at the lower end, the FI is aggressively net short. The bulls will be hoping that both these two factors play in their advantage. The call writing, though, continues. 25,000 call aggressive writing is what we saw in yesterday's trading session. So let's give you the levels then. This market has turned into a sell and rise, and the structure itself has been broken. But I'll be looking at important support levels. And I think the 24,400, 24,500 level is very, very important. It coincides with yesterday's low, which was ballpark around 24,570. And even the low that we saw on 30th of September, when we made that low of around 24,588 or thereabouts. So holding on to that 24,500 is an important data point. Otherwise, we're bracing for a sharper correction. The Nifty Bank as well has pulled back considerably from around that 60,000 odd mark, which was just a couple of trading sessions ago. So the 100 DMA is now a reference point at around that 58,000 odd mark. And yesterday's low at around 57,780. You don't want that range to break on the downside. So we're positioned for a weak trading session. Let's see whether or not that happens. But my gut is we do see some kind of recovery from the lows, because yesterday it appears that we actually overextended ourselves on the short side just in the near term.
Okay, so the PCR is at oversold levels
And
of
the FI net
0.6.
shorts.
The auto sales numbers are good. And plus, crude prices have also, come off from levels of $70, $71. It's down to about 67, 68. But let's invite Samir. Okay, before that, the futures and options tax was hiked and it stumped Dalal Street. The sensex and nifty posted its biggest budget day decline seen in the last 6 years. So before we get our experts in, listen in to the Revenue Secretary explaining the rationale behind the STT hike.
If you look at the volume of the F&O, if you compare it to the underlying securities market volume itself, or the size of the GDP for that matter, it is too large for it to be considered desirable. It looks to be fairly speculative, which is not a good way to take it forward. So in some way, this increase is essentially meant to address that kind of, possible risks that may be involved in this highly speculative side of the market. With no impact in the volume, if the volume remains the same, put together, it may fetch us around 15,000 crores or so.
Samir Arora is with us, founder and fund manager at Helios Capital. Samir joined us yesterday morning as soon as the finance minister budget speech ended. Samir and I sort of posted that later last night, and really lots of comments, mostly thanking you to kind of sort of that you expressed what a lot of people are feeling. So any changes in the mood, thought process?
So
as I said, budget plus one.
Let me explain for everybody's benefit. So the point is, I think that the market participants and even the government feel that the market is just dependent on other sectors. So, when the, say, Mahindra and Mahindra CEO will come, he will talk about how the budget has helped the auto sector. But if in that budget, the help had gone to quick commerce sector, then the Mahindra and Mahindra CEO will say it's an okay budget, bad budget, whatever. The point is that we should look, and the government should look, and the system should look at the market as an independent sector also. In addition to saying because it helps data centers, it will help the market. Because the market has many other factors, for example, taxes, FII taxes, liquidity, and relative this market versus that market. And so when the market is bad, like say today the textile sector is bad because of US tariffs, then the government says we are going to help the textile companies with whatever, either cheaper loans, this, that. Currently, in the last 1 year, the Indian market has done very badly. And look at it in dollar terms or more, look at it in euro terms, Swiss terms, because maybe X percent, 20, 30, whatever percent of the people might be coming from Europe and Switzerland, and they would have lost more than 20% on currency alone. So in that context, it should be at least accepted, recognized, maybe 5 lines should be said that, we are keeping a watch on this, and if it goes beyond a point, we will do. In that context, to put a charge, even if it is to squeeze liquidity of, by the way, if you see me on Twitter, hundreds of times I have said that STT should be increased on futures and options, but always accompanied by a corresponding lowering of either capital gains tax or lowering of STT for cash or doing something. So that's why this one is that we are not accepting the fact that if you get, say, $5 billion through some FDI with doing hundreds of things, you can get it in 1 hour with the FPI guy if you understand the power of the market. The FPI guys or FII guys can put 5 billion in a month or in a week, and all they need is a little bit of recognition of their role and the fact that this money is easier to get. It funds Indian promoters. All it needs is fairness and a little bit of recognition of the role of stock market per se itself.
Samir, we played out the Revenue Secretary soundbite, right? And Shireen spoke with him. That you just played it before we came to you. What he said is, this is not to raise revenue. This is to...
I saw it.
Yeah.
I saw it.
This is to...
But the fact is now you've got 15,000 crores, so please give it to the other side.
I am asking you whether this is actually even... Because it seems like it's kind of... They're taking a stance. So it's ideological in that sense, that we want to curb speculation.
I don't myself, by the way, I myself used to say it, that it is too much. I agree.
Okay.
But you see, you need it in a certain environment.
Yeah.
You can't have it in an environment where India is massively underperforming, and primarily because the stock market is doing badly relatively and all that, and FPIs are leading. You need a certain time for that. And also, this gives the impression that the market itself is not of importance. And I am saying that the market should be seen as a separate this thing, and I am the self-appointed representative of the market or of FPIs. But I'm saying the market can solve so many problems. The market is like an ad. It's an ad of the country. If the world sees that the market is down and the currency is down, without looking, they think that the budget is bad, which is what I keep recommending this book, The Halo Effect. The price also determines many things. And then, therefore, you will postpone things saying, no, that means nothing has changed. Everything changes. And why should we be? And it's some of it you may say, we are overvalued and all, which I don't believe too much. Some of it is because we have extra taxes, extra STT, etc., which in bad time comes out. In good times, nobody cares because it absorbs, the fact that the performance.
You don't mind paying a little bit more. Yeah, you don't mind.
But you say it doesn't matter because overall. So what I'm saying is, it is for these times, and even now you don't have to do it.
Yeah.
But please say it that, we are watching this closely and we are going to track it and, we are not letting it. Everything helps. But at that time to do an STT is like saying we don't care. And that is the negative part. Not so much that whether what is happening in EMS companies or what is happening in defense, obviously. And by the way, we still own all those. By the way, even yesterday, of course, before the budget started, we bought a lot for our FPI account. Some of these which actually did okay. But anyway, so the point is, nobody's walking away. So this idea, if you don't like it, go to another country. If you don't like it, how come the market went up in 24? That's not the point. Yeah. It's like the textile guys want their relief, and all the time the auto guy says don't open to Chinese competition. We are saying please look at our market as one more independent sector, and not only that, if other things are doing well, this market will do well because there are so many other elements over and above.
Yeah. Samir, so I'm
liquidity, tax rates, commission rates, hundreds of things. Yeah.
I'm paraphrasing you. Government should at least give verbal support to markets, if not in action.
No. Verbal first, and then if needed action, not only verbal.
No. I want to get that.
But definitely not hurt the market at a time when it is anyway being isolated in the world as being a poor performer. Mostly we might be last in the world this year or something like that.
100%. So what will FPIs do now today? That is a big question. Will they become...
The thing is, FPIs were already selling, which is why I was saying yesterday, this cannot change it now. How will this change it? And also today, of course, the world is bad and all that. So I would think that FPIs would sell. I don't know. Because I'm a long only guy in that, and the long short, I keep doing various things. We actually, as I said, bought yesterday also, but okay, all before the budget. But what I'm saying is that I would think that because they were selling, in that context, at that time, we should not be doing things which are negative, because this means they will not change currently. Now, after 5 days, 10 days, 20 days, if there is a US deal or something which changes the sentiment for India relative to other markets, then it'd be different. But right now, how will that momentum stop?
So, Samir, I get the fact that you would have wanted an offset. But just analyzing the impact of STT standalone, are we over worried about the impact of it drying up liquidity in the market? Because in the past also STT has gone up and the overall market has gone up and we've managed to absorb it.
So I would think that all these big guys who come on your channel should worry. I am the smallest mutual fund and a small FII. So if it is good enough for all these guys who like it, then it's good enough for me. So I don't care about the liquidity part, basically because we are smaller than all the guys who don't care about it. So it's okay.
Okay. And so now that there is an STT hike and there are no incentives for FIIs, since you are the representative for the FPIs, self-appointed representative, does India need a higher equity risk premium, to your mind?
So right now it does, because the currency has come in and created a big problem. Another thing is that even in the days when, in the last 1 or 2 weeks, when the US dollar weakened a lot overnight, even then we used to open 10 basis points down and 20 basis points down, while the rest of the world And by the way, if you look at it in other currencies, it is dramatic. It is very, very, that's what I keep saying that, it's embarrassing. I have a call this Friday with one European current investor. Now, how to explain? We keep saying we are a dollar fund, this, that, but we know that they are basically euro investors. And how to explain that, hang in there for 2 more years, 3 more years, because last 2 years they would have lost, if we look at in their currency, maybe 20% on currency alone. These are very serious issues where, something had to be done. So that's why it's like, as I said, the point is, if in any other sector there is something bad happening, then temporarily the government helps. Like it temporarily reduces or increases some duties or reduces some import duties. It temporarily says, I will give textile industry lower cost loans. It had to temporarily, if not for permanently, help.
Yeah, no, 100%. Anything on the back of this budget to do this way, that way? Single stocks, anything? Samir?
So right now, we still haven't had a proper meeting with our analysts. This was my impression on that day of the instant this thing. So we'll see, but broadly 1 or 2 days. So definitely we're not going to do anything on the long side for sure, 100%. Because I think the market will dominate rather than any one stock that may have done better. By the way, yesterday, even after budget, we did, I remember now, for that same account, we did buy one stock, which is 197. But again, I'm not buying more today.
You already own it in that sense.
Yeah, but yesterday for that other new FI account, I'm just saying that even after the budget, we were buying. So it's not that everything completely stops.
Yeah.
But what I'm saying broadly is that the market needed a bit of hand-holding support, words, and actually some action, maybe, or promise of an action, at least if things go worse. And also to recognize that people are paying taxes in rupees and then losing on the currency. Somebody has to accept it and not say that because auto sector will do well and because defense sector will do well, therefore the market will automatically do well. Right. That it does most of the times in a steady state. But because of these extra frictional costs, which are now only in India primarily related to FPI taxes and now very high STT even in general.
Right.
That at some point you need it back and forth. That is what it is.
Okay, well, you're in a holding pattern, wait and watch for the next 2 days. Samir, we'll speak to you again, but thank you so much for joining us joining us on the day of the budget, and of course joining us now as well. It's been
I think Samir is sounding a little more upbeat today actually, and at least some tinge of a green coat, at least a little better, Samir.
So I matched it with my green new specs.
Super.
And also, of course, what I want the market to still be.
And you deployed some money yesterday. That's why I'm saying a little bit more optimistic today, this morning, with those green specs, green coat, and hopefully green market later this week.
And an orange shirt.
And I'm sure, Samir, the advice is being heard and perhaps hopefully acted upon as well in the relevant quarters. Thank you very much. Appreciate it. Well, I think that's Samir Arora, and so that's the view coming in. It is what it is, right? Let's just quickly run you through interactions which are lined up over the next 2.5 hours or so before we go any further. So at 8:35, Harshit Kapadia will take a look at the infrastructure, capital goods areas. Defense, of course, stocks all sold off, but they had done well going into the budget. 9 o'clock, we have Rajesh Baheti, STT, capital market impact coming through. We'll ask him what is that. 9:20, S. Narain of ICICI Pru. AMC is one of the largest money managers in India. 9:30, I think that's a conversation everybody wants to hear once the budget is over. That is with Neelkant Mishra. On the equity strategy side, we have none other than Rhythm Desai joining us at 9:50. That is going to be a big one that you don't want to miss. We, of course, also will focus on individual company earnings. In that sense, Chola will be joining us as well. 10 o'clock, the management of Dixon. There is, of course, increase in allocation towards the EMS space to 40,000 crores from 26,000 crores earlier. Saurabh Gupta, CFO of Dixon. And towards the end of the program, Latha in conversation with CNBC-TV18 Citizen MPC head of the monetary policy. That is later this Friday.
Welcome back. You're watching Bazaar Morning Call, and moving on now to the individual stocks that you need to have on your radar this morning. Our research team is standing by with the top stocks to watch for the day. But Ritu, first up, it's over to you on the budget and macros.
Well, Reema, overall, the street reaction to the union budget is largely pragmatic, not very excited, not really disappointed, but clearly calling it a very cautious consolidation-led budget. Now, Morgan Stanley says the budget balances debt reduction with growth support, but consolidation is at the slowest pace that we've seen since the pandemic. They also flagged that the strong semiconductor focus, which you saw at the very start of the speech, is perhaps a strategic pivot for India as well. Deutsche Bank calls the stance conservative and credibility enhancing, and HDFC Bank sums it up simply foundational, not fireworks. They say the fiscal math is pretty cautious and it is broadly credible. Nomura also echoes that sentiment, saying it is no big bang budget. Citi says overall it is negative for brokers, for exchanges, PSU banks, and positive for select industrials, particularly defense, OMCs, cables and wires, etc. For CLSA, it says overall again positive for defense and EMS stocks, negative for PSU banks because of that large borrowing. Bernstein again says no reason to alter its 12-month outlook based on the budget, even with the recent market decline. Now, on growth, the street believes the assumption of 10% nominal GDP growth for the next fiscal, it is a tad too conservative. HDFC Bank says its own estimate is about 10.5%. Axis Bank also says the actual outcome could be much better than what the government is projecting. And Deutsche Bank says the growth map is credible, but Bernstein adds the budget has only delivered what was feasible within the limited flexibility it had. Now, on consolidation, most do see the glide path slowing down. So Morgan Stanley calls the numbers realistic but very gradual. And HDFC warns that the gentler debt reduction we are seeing now may require a much faster tightening later to get to the 50 to 51% debt to GDP target by FY31. Deutsche Bank sees the risk of slightly higher revenue spending and some capex slippage as well, given the past record. And Jeffrey says a marginally higher deficit can put pressure on yields. Axis points out that the pace of fiscal consolidation has slowed down, and without stronger disinvestment, which is a challenge, further consolidation can be difficult. And finally, borrowing, the big bond market concern. HDFC flags that while the net borrowing is as expected, gross borrowing at 17.2 lakh crores is far higher than market estimates. They warn that can push the 10-year into the territory of 6.8% kind of a range in the near term. Deutsche Bank and CLSA also say this heavy bond supply will weigh on the market sentiments, and Citi expects continued RBI OMOs to manage liquidity and the yield. So to sum it up, steady growth support through capex, conservative fiscal math, positive for defense and industrials, but bond markets, they could feel the pressure first.
All right, Ritu, thank you very much for that. So that's the D Street verdict in that sense. Well, let's go straight from macro top down to stock specific stuff, right, in terms of what will move. And it's always, budget day plus one, day two. There are these individual movers and shakers. Vivek is here with what's on his radar. Vivek, morning.
Well, good morning. That's right. So, we've called out the top 10 list of sector stocks that we have to keep on our radar on the back of the fact of the budget speech. The first sector, of course, has to be the IT pack, a relative outperformer yesterday. Reduced tax incidence on buybacks, both for promoter as well as non-promoter entities, as well as rationalization of the tax incidence for corporates as well as non-corporates holding these companies is something that is seen quite positively. One clear beneficiary is the defense, the roadways as well as the railways pack. Core capex has positively surprised core capex growth at 14% versus 16% in FY26 budgeted estimate. FY27 budget too for the entire pack has seen higher by almost 8 to 11% versus a flat growth last year around. Defense budget is up 18%, so expect the entire set of stocks to remain in focus. The third set of stocks will be the power financiers, PFC as well as REC. They are planning to restructure both of these entities. Analysts estimate a merger will help PFC go ahead and reduce the holding company discount it currently suffers from. Keep an eye out on the entire pharma pack. The Biopharma Shakti scheme has been given a strong outlay of close to 10,000 crore rupees. Merchant banking in terms of Paytm as well as PhonePe, they have gone ahead and reinstated the UPI incentives at 2,000 crore for FY27. The entire EMS pack will be in focus. They've gone ahead and increased the outlay to 40,000 crore for the electronics component manufacturing scheme versus last year's 22,900 crore. The entire textile pack will be in focus. three key schemes announced over there: integrated textile program outlay with 1,500 crore budgeted for that, mega textile parks, as well as Mahatma Gandhi Gram Swaraj initiative. And the last positive set of stocks will be the data center initiative that's been announced. Anantraj Netweb Lodha will be in focus, close to 20-year tax exemption for the cloud service providers. Now, coming to the set of negatives, you can't look beyond the exchanges, BSE, Angel One, Nuvama Wealth, Grow. Remember, STT on futures has been increased from 2 basis points to 5 basis points, and from 10 to 12.5 basis points to 15 basis points on option premium. For BSE, almost 60% of the revenues comes from this particular segment, so it'll be interesting to watch whether there is further downside today. Dixon Technologies, one stock from the EMS pack. Remember, mobile PLI has not been extended, and PSU banks will remain in focus. Higher than expected gross borrowing could lead to treasury losses that these companies could face, and also lack of clarity as far as foreign ownership limits could also weigh in on the stocks today.
Okay, all right, Vivek, thanks a lot for that. Well, let's hop across to Manisha Gupta, who's joining in to tell us all the action she's picking up from the commodities market. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, the sell-off has continued for a second straight day today. Friday was some kind of a deluge. You saw a complete sell-off happen in many of those metals. And today there's a follow-up selling that we're looking at in the Asian market. I'll start with copper because we've seen nearly 2% of a decline coming in for that one right now. If you look at from its all-time highs, copper has declined by 11% from last week's all-time high. Well, this is the speculative rally that we saw in gold and silver and copper, in various other metals as well. What has happened is, one, the rally has met with resistance. There is profit-taking coming in because there was overheated condition in the market. Second, you have seen the dollar index gain quite strongly, whether it is about the new Fed chief or the fact that the Japan Prime Minister has said that weak Japanese yen works in the favor of exports therein. The third thing really has been about the Chinese selling. That is where markets believe the most froth really came in from. The sentiment change that has come in from China also has led to a lot of decline. So whether it's about gold, which is down 5% right now, silver after declining 36% on Friday is trading 5% down right now. And most metals are down anywhere between 8 to 12% from their all-time highs in previous month.
All right. Manisha, the rupee, when MCX opens today, in rupee terms, will it reflect this correction, or I think the prices kind of closed lower than the Friday kind of close. So it's kind of adjusting for this fall this morning, gold and silver?
It is. Because yesterday international markets were shut but we were open, and there was a sense that the lower circuits would perhaps still continue. So we've seen a further decline than what the international markets have done.
Okay. All right. So, I mean, it kind of compensated a little bit to in terms of what we are seeing right now. Manisha, thank you very much for that. It's a story we'll continue, of course, to follow. Lots of interest. I mean, equity is one, but commodities, last 48 hours of market trading has been phenomenal. We take a quick commercial break here. Dharmesh Kant of Chola Securities with us on the other side for some fundamental stock conversation.
Welcome back. You're tuned into Bazaar Morning Call, and we've got a market to contend with, barring the negative sentiment that we've seen yesterday. Dharmesh Khan joins us on the show. Hi, Dharmesh. Good morning. Good to see you win. Well, it seems yesterday there was a bit of an overreaction on the downside, at least because of the sentiment hit that we got. What's your view? And did you spot anything that was positive and that in tail would, force you to go ahead and buy a couple of stocks? If you could name 2-3 beneficiaries of Budget 2026.
Yeah, good morning, Nigel. Thanks for having me for the show. So if you recall yesterday's conversations around the same time, I have pointed out that spending is what is more critical in the budget. Of course, allocation does matter, but it's more to do with spending. And spending was good this time around. Even the capex for the government has done 10,95,000 odd crores. It was only down by 2%. Usual rate of, downfalls has been 8 to 9% going by last 2 years number. Defense particularly came out very well. Even they exceeded the allocation. About 14% more spending was done in the defense for likely to do for revised estimates for this time around. Same is the case with railways. the spending was pretty well, and the power sector. So I think the critical areas where the spending should be done, government has exceeded what they have allocated for last year budget, estimates. And this year again, there has been an incremental increase. Defense, yesterday there was sharp reaction on most of the stocks. They came down sharply. But I think this is a good time and opportunity to buy them, because if you look at the entire defense space, they are sitting on 4.5 times book-to-bill ratio. So very healthy order book in excess of 3 lakh odd crores for 8 to 9 defense companies put together. And their HAL, BDL is standing at a book-to-bill ratio more than 6x. VEL itself is standing at a book-to-bill ratio of 3x. So strong order book visibility, all strong execution visibility over the next 2 to 3 years time frame. And this is, just allocating more, but execution will take its own sweet time. So our sense is 18 to 20% kind of a profitability compounding is likely out there. And there still the topic remains Hindustan Aeronautics because of the valuation comfort it enjoys as compared to BEL, and the structural problems of jet engines not getting, aircraft engines not being supplied by GE is now being resolved. So but that supply will enhance. Railway, I think, is one sector which has been languishing for last 2 years, and now it's the time to look at it again. After 3 years of budgetary allocation, this time around there has been a growth in the railway spending around 11%. Execution has also started picking up, and there, to my mind, Ircon International, because of valuation comfort, stands a good chance. Is standing over 24,000 odd crores of order book and doubling of railway lines and more gauges to be put in place. All this will, put in line, will go smoothly with Ircon International. Valuation-wise, it's comfortable as compared to, say, others in the peer like RBN and all. So these two sectors look pretty strong to me. And I think yesterday it was an overreaction to the market. Today, if market gives you a chance to, open on low side, you should be going all long on the market, because looking at the numbers, ex-nifty, around 325 companies we have done in aggregates on year-on-year basis. The PAT number has grown by 16%, and quarter-on-quarter they have grown by 6%. This is after adjusting for the labor costs. So the outside larger market is very strong. Large caps may take its own time, but the market itself looks very healthy and very juicier at current valuation multiples to do cherry picking.
So HAL and Ircon. HAL trades at 30 times forward multiple. What about Ircon's forward valuation? What is it?
So Ircon forward valuation will be around 21, 22 times. Okay. But I think the execution is likely to pick up. So this can get, to 19 times or 18.5 times.
Got that. The big positive is also the 21-year tax holiday to foreign companies to set up data centers in India. What is the investable play here in India? And if you could, give us 1-2 stocks and the rationale behind it, if at all.
Rima, good morning. It's a very large space, and it will take its own sweet course of time to get us into the entire, revenue and PAT kind of earnings visibility. We have to see how much of it comes to the Indian companies, and there I think a couple of companies are there. We have initiated coverage on Orion Pro Solutions Limited. They are there in the data center structural architecture stack. And what they do is an asset-light model. They design the entire data center model, do the software integration into the hardware, and that is where they make enough profit. So right now it's around 18 to 17% of their entire revenue pie, which is likely to go up in near future. They have already done 2 projects with RBI and one more company, and the name just I'm missing out right now. So they also have a historical track. Other than that, NetWeb is already there. E2 is there. So NetWeb and Orion Pro Solutions, I think they should stand to gain significantly from this entire, offering coming in future. But it won't happen overnight. It won't happen in a couple of quarters, because a lot of structural issues are there. First, allocation of land and putting in the entire real estate infrastructure in place. So maybe 1 year down the line, we can see the benefits of it trickling down to the profitability.
Dharmesh, this morning when I think at 9 o'clock bond markets, etc. open, I think, the sense is perhaps you will see an uptick in yields because of that gross borrowing number. Financials, NBFCs, any thoughts on that pack? If the market, that's not your view. Your view is actually based on earnings that you've looked at. It's looking healthier. But, there's another segment which believes actually everybody's going to go sit in banks because, it's perhaps valuation comfort, safety and things like that. But these rising yields, does that sour that view in any way?
In very short term, yes, because there would be mark-to-market losses in the treasury side, and that can take up part of the profitability, which happened in Q1. I mean, the same phenomena played out there. Q3, somewhat rebalancing was done, but again, the same problem crops up there, and it's 35% of their profitability. The treasury income, it has a significant chunk in most of the bank's profitability. So, but definitely, yeah, from a trading point of view, I think there should be some decline out there. Yesterday, we saw sharp selling in most of the PSU banks. 7-8% kind of a correction was already there. Maybe 3-5% more, but again, my long-term call is you should be buying those corrections.
Okay, and what about the capital market plays? BSE got slammed yesterday. I saw on Friday as well, the stock lost its way second half of the trading session, and it's followed that up yesterday with another slam dunk. What would you do? Any of these capital market plays you want to dip in, or you rather stay away?
Yeah, Nigel, I mean, as far as wealth management, asset management companies are concerned, they are a good pick out there. But BSE, MCX, I mean, all the infra plays, definitely, there are two reasons. One is the STT hike, which happened yesterday, which will definitely cut down on volumes of most of the derivative algo trades. So all synthetic trades, high frequency algo trades will see a trim down, but it will happen 2 months later. I mean, from April, it will be effective. So we have a window of 2 months out there. The second most important reason is the NSE is coming out with an IPO, and there was a differential in the valuation multiple going by the unlisted price of NSE shares between BSE and NSE. So that I think will get adjusted right now. So for some time, I mean, maybe 6 months or down the line, till this entire NSE IPO is through, sustainable traction on BSE shares is unlikely. It may take time-wise correction, but I don't think it's going to have a healthy upside traction.
Okay, Dharmesh, appreciate you joining in and giving us some stocks this morning. Defense, railways, some of the data center plays as well is what you're pretty positive on, while you're saying capital market plays maybe go through a phase of consolidation, so you'd rather stay away. Have a good day ahead, and we catch up soon. Thanks a lot for joining in. Well, we'll slip into a short break. On the other side, we'll connect with Harshit Kapadia of Elara Securities as well as Rajesh Baheti of Cross Seas Capital Services. But also do note, in a while, we'll also connect with S. Naren, Neelkant Mishra and Rhythm Desai. They'll join in to decode budget 2026. Stay tuned.
Welcome back. Defense stocks, right, were in focus actually going into the budget. They were focused yesterday as well. The market sold off, and so did defense stocks. Capital goods perhaps is the other area. Ria is joining in with the granular stuff here. I mean, what really happened in terms of future ordering, etc. Are analysts excited? Is this subpar? Ria, take it away.
Well, yes, first up, Goldman Sachs has come out with a note on the defense space after yesterday's budget. They have highlighted that the FY27 defense budget spend came ahead of their estimates. And they have also said that within capital procurement for this budget for other equipment, which comprises missiles, ammunition, as well as radar electronics, that is up roughly 62% compared to last year at 82,200 crores. They believe that solar industries, Bharat Electronics, as well as Bharat Dynamics are well placed to benefit from the spending focus on other equipment, and they also see a potential trickle-down benefit for Astra Microwave as well as for data patterns. Apart from this, they have also highlighted that in case of the aerospace segment, the exemption of the basic customs duty on raw materials for the manufacture of parts and components of aircraft is likely to benefit companies like PTC Industries as well as Azad Engineering. Apart from this, CLSA has also come out with a note on the capital goods space. They have said that the $200 billion US worth of projects for 7 new bullet trains and a new dedicated freight corridor was an important part of the budget yesterday. And they've also said that the defense capex growth of 17% year on year should reassure the market. But they also believe that there is no constraint for this, and it depends on project delivery. They've reiterated their outperform rating on L&T, HAL, Bharat Electronics as well as NCC as orders and execution recover in 2026, which could surprise the markets.
Thank you very much for that. But there was a violent reaction and sell-off in the stocks yesterday. Bharat Dynamics ended down 10%. Data Patterns 7.5%. BEL was one of the big nifty losers, a fall of about 5.5%. Harshit Kapadia of Elara Securities is now joining in. Harshit, your initial read, and if you had to pick one or two defense budget stocks, which ones would it be and why?
Morning. Yes, so defense budget has seen a very good increase of close to around 17% on a YY basis compared to the revised estimate, which is at 2.2 lakh crore. And then that 75% is allocated for domestic procurement. So all number comes to around 1.4 lakh crores against 1.2 lakh crores. So that's a sharp increase. And within that, what we have seen is there has been a upward trend on the other equipment side, construction side, and high mobility vehicle side. So these are three key segments where we would see growth coming in. Within this, if I want to pick on the defense side, I would pick BML and Hindustan Aeronautics as my top picks on the defense side, followed by Bharat Dynamics. This is the three companies that I would be watching out for on the PSU side. This will be followed by Solar Industries on private side.
Okay, got it. So we've got the picks in terms of the defense allocation. Harshit, what about railways? Out there as well, the spend is pretty much in line with what the street was working with. Your take on that? And from the railways pack, what stands out?
So on railways pack, if you see the headline number looks good, but when you get into nitty-gritties, into volume numbers, you will see a sharp variation. So only two segments within railway has seen growth in terms of volume. One is coaches and the other is locomotive. Whereas the doubling of lines, track lines have seen a decline in volume. However, the value number has increased for doubling of lines and new lines construction, which means a lot of commodity price related inflation has been booked. So prima facie, it may look good to get into EPC companies for the railway side, but I would be preferring more on coaches and locomotive side. So companies which still again picks would be BML within the space, Siemens Limited would be another pick within the space, and on the component side it would be CG Power and ABB India. These are the companies to watch out for. And the third component which I mentioned, which I forgot to mention, was on the Kavach side. We have also seen a Kavach segment related increase as well, which will see a HBL Power coming in, CG Power coming in terms of Kavach orders as well.
Right. Sorry, before CG, Harshit, what did you say? Which is the company?
HBL Power.
No. The earlier on the loco and coaches side.
So on the BML, that is where the first company is. Then Siemens Limited is the another company on the loco side who will benefit.
What did you mean when you say volumes so we get the rupee crore number, right? In terms of allocation, what do you mean volume? You said only volume increase in these two segments.
Yes. So in terms of number of coaches which the government is planning to procure for FY27 has seen an increase of 10%. For locomotives, it is an increase of 7%. The value growth has been close to around 3 and 8%. Whereas when you look at doubling of lines, we have seen a volume decline in terms of kilometers of 8% for doubling of lines. For new line construction, we have seen a volume decline of 20%. But if you see the value rise in new lines and construction has been in the range of 10 to 20%. So there is a differentiation here as far as doubling of lines is concerned, and the other on the coaches side is concerned in the railways.
Now, all these picks in these segments, right? I'm assuming you had coverage, you liked them, had buys before the budget also.
Yes.
Would these announcements and increase in allocations in these segments make you want to buy them incrementally? If you don't own them, or no?
No, these announcements will certainly give me more color that more order inflows are sustainable in this segment, and this is what the government is looking more towards new age trains, which is Vande Bharat, Amrit Bharat trains. So this gives me further confidence on the picks that I have already mentioned.
All right, we'll leave it there. Harshit, thanks very much for joining us. Quick conversation, but very useful. And that's railways in focus, defense in focus as well. So some nuance there, which I think is important to note. We take a break. We're back. The pre-open session is coming up in about 6 minutes' time. And the other one, right? Capital markets, where do we stand now there? So SCT changes in F&O 51-50% hikes respectively. Rajesh Baheti will be with us. We'll also connect with S. Naren, Neelkant Mishra and Rhythm Desai. So the trio, the big market faces coming up. So we'll have the big AMC view, we've got the equity strategy view, and of course we've got a top economist/strategy view coming in from the three of them. So those are faces you will see here on CNBC TV 18. Stay tuned, coming back.
Welcome back. This is Open Exchange, and we are coming to you live from the CNBC TV 18 Motilal Oswal studio. As promised, let's welcome our technical guests. We have Mitesh Thakkar and Sudarshan Sukani who join us on the show. Good morning, gentlemen. Good to see you all in. Well, we were bracing for a super Sunday. It didn't really play out that way for the Bulls. But now, will we get a manic Monday or not? What's your take? Mitesh, coming across to you first. It seems yesterday, particularly the last 30 minutes, the positioning was taken for a gap down today. But what happens post that? Tell us, Mitesh, the levels that you're looking at. How would you trade the Nifty?
So, good morning, Nigel. A couple of things. I've been saying that the market is on the weaker side, and 25,000, 24,950 was a support area, which yesterday the Nifty kind of broke below. Now, that's a rising trend line which has been taken out, which also means that any pullbacks will face strong supply around this 24,950, 25,000 zones. And if you're not able to capture that, which means that the market weakness will persist and therefore should logically force us to lower levels, which could be close to about 24,400 to begin with, and even 24,000 in the near term could happen. So in that sense, the structure is negative unless we start capturing or trading beyond 25,000 on the upside.
Sudarshan, would you play for more downside? And where do you see the Nifty headed?
Yeah, good morning. Well, yesterday the idea was to take a short position below 25,100, but I don't think that was actually possible in real life because it was so volatile. Trading yesterday would have been difficult practically. But the bigger worry is that, for the Nifty has been in a trading range between, let's say, 25,000 and 26,300 for 6, 7, or maybe 8 months. That range is breaking decisively on the downside. Now that starts looking very sinister, like a distribution. Now, Indian markets don't distribute. We simply buy on the dips. So it's a very unusual pattern for India. For today, I would be a complete bystander, avoid any trading. Let's see what the markets are doing. Are they willing to buy this dip, or is that really a distribution for a much longer downtrend? But for today, it's an avoid.
Okay, all right. I think we need to pull up. I think the rupee, we're getting the initial rates that should come up actually for our viewers. If you've got the initial rates, it's 9 a.m. So I think we'll be getting the rate on the rupee. Director is just going to confirm in a bit. Just wait for a minute or so. For the time being, let's get in Mitesh. Mitesh, tell us individual stocks.
I have more of sell calls today. I have a sell on Bank of Baroda, which after a good rally has given some kind of a breakdown showing first signs of profit booking. So keep a stop just about 286 here. Look for targets of 265 on the downside. Similarly, Tata Consumer is a negative or a sell call as well. I would suggest keeping a stop loss just above 1110 levels and look for a target of around 1040 on the downside. I have a buy on CG Power with a stop at 580 for targets of around 630 on the upside, and Nuvama Capital is a sell as well. Keep a stop at 1270, and a short-term decline could see the price head towards around 1200.
Look at that, 20 paisa stronger on the rupee. So I'm not sure if there is some strong defense coming in right at the word go, right? We'll try and get some intel and some feedback. But this is stronger at this point. We'll also, if we can have the 10-year yield, which perhaps we can put up, because the bond market would also have opened. There was some expectation that perhaps yields open a little higher, but we'll have to see. I mean, look at this. And remember, the rupee market, from the time that we closed, the rupee closed on Friday to now, the dollar is up. The dollar index is up about almost, it's back above 97, right? I mean, the broader dollar index. And here you've got the rupee going the other way. So there is, as I said, Bloomberg is saying, and we'll put this out, RBI selling dollars offshore to protect the rupee. And this is what I was talking about, that it looks like for this kind of a start, after the worries around gross borrowing, the dollar going the other way, for the rupee to start 20 paisa higher, I mean, I think there is strong defense on the front foot right at the word go. Bond yields have surged, as was expected, as I was saying in the morning, 6.77 compared to, that's a 10 basis point higher start on bonds. Yeah, there you go, 6.77. And it's compared to 6.69, which was the last close. So bond yields are higher. Rupee for now, of course, is managing with help from the Reserve Bank, providing dollars to keep its hold its own. But this is just the start, and we'll have to see what happens 9:15 onwards. Because I mean, the big problem for markets, for the rupee, for all of this essentially has been FPIs who've been actually selling stock, right? So what happens starting 9:15, I think, is the critical point, and that we don't have to wait very long, another 10, 12 minutes or so. Sudarshan and Mitesh, good morning. Good to have both of you here. So individually, what would you want to do? Sudarshan, you go first.
Yes, it's I have more bias because there are opportunities of buying this dip for stocks. HCL Tech is a buy with a stop under 1610. Vedant is a buy with a stop under 610. Oil India Oil is a buy with a stop under 491. One short selling idea is TVS Motors, sell with a stop above 3690. But there may be some bargain hunting, at least in stocks.
Okay, what about? Okay, yeah, no. We'll come back to both of you in just a bit. Thank you very much for joining us, gentlemen. Really appreciate your time. And keep an eye out on what's happening at the bottom of the screen as well with rupee and yields. Rajesh Baheti, Managing Director at Crosseas Capital Services, is with us. Rajesh, good morning. Good to have you here. Sorry, I'm taking you away from your tennis. So you can play later. The weather is nice. So this STT hike, Rajesh, both the futures and options, first of all, it was not expected. 50%, 150%. What will this do, in your opinion, in terms of market impact?
So first, let's understand that the futures and options industry is now the financial equivalent of pan masala, tobacco, alcohol, casinos. So if we're not expecting it, I think that's probably our fault. The government signaling is very, very clear. They don't want this. They think it's undesirable. The problem is they will tell you this, and mostly it is to raise revenue, because if it wasn't, they should have at the same time cut delivery-based STT to 0. If they had done this along with this hike, I think the market would have rejoiced it and said, yes, this is signaling. It's telling you that you don't want an activity of a particular kind, but you do want an activity of another kind, and we would encourage that. Unfortunately, we get one, we don't get the other.
But it can't both be true, Rajesh. The objective of this is on the speculation side, you have all those comparisons, pan masala, tobacco, etc. On the other side, you don't want to do that to protect revenue because it's a tough year. I mean, I'm just saying.
But you saw that interview. They were clear in saying that this is not about revenue. I mean, it wasn't about revenue, and it was about signaling. Then I think a very strong signal could have been sent to the market by removing the extra STT you pay on delivery-based trades, telling the market, go ahead, take delivery, invest, and we're not going to tax you because...
No, I agree. I am saying they could not do that because they don't want to lose revenue while they want to do this. That's what I'm saying.
You're talking about 10,000 crores. What's the
I don't
on this?
I'm not. Crores? I'm just saying. Is it possible that both are true? This and that, because you said, well, they're signaling it, but obviously it's not showing up in action.
Yeah, but if you're going to want to take 10,000 crores and take the market down by 6.5-7 lakh crores, I think that's poor economics.
Rajesh, have you spoken to any high-frequency traders, arbitrageurs? What is the feedback that they expect? Because their margins are anyway razor thin. So what impact do you foresee on liquidity, on the behavior of HFT and arbitrageurs?
You know, the strategy of the government is to not break the rubber band, but keep pulling it and see at what point does it break. We don't know when this STT comes into play. We'll really know the structure of the market, how the market adjusts. But you can be sure it's going to hurt. It's going to hurt the high frequency traders the most. But they are the ones that provide the liquidity. So, you know, if you think liquidity does not become a very important factor for FPIs to decide which markets to put your money in, I think there's a little bit of a disconnect in what the government wants to do and what could happen.
Okay, hi Rajesh, good morning, good to see you again. How much does the cost effectively go out, on a particular contract for futures as well as options? And there was some who were talking that higher volume shift to options rather than futures because of the STT shift now. Any view?
Futures was already like a very small percent of the options volume. If you actually saw the volume, it was anyway skewed in favor of options. It could just get unviable to trade either at some point. And so I don't know if this point has been reached or not, but at some point it will get unviable for professional traders to trade this anymore, which will have serious repercussions for liquidity.
Yeah, got that. You know, you can, now again, I'm just playing devil's advocate here. There is one viewpoint that whenever, look at past instances, whenever STT was hiked, right? 2030, 2023, 24, etc. as well. It's not as if volumes took a large hit, or activity took a large hit, Rajesh. How would you respond to that?
So that's what I'm saying. You know, you're stretching the rubber band. I don't know whether this is the breaking point or no. So when the move actually happens and the STT does go up, we are there in the market. At some point, some people will pull out of trading. I don't know whether it's us this time or the high frequency traders. It's yet to be seen. But at some point, I think it will become unviable.
From a customer point of view, you don't see this changing. This is what is reducing speculation, is what this is aimed at, reducing or rather changing customer behavior, Rajesh? Client behavior or trader behavior?
I mean, if the client or the retail client behavior is to buy or sell some option and hang on to it for days and weeks till either you double your money or you completely zero out your position and lose everything, then it's not going to be a game changer. What it will do is it will make bid and ask spreads wider. And that's where the repercussions are for not only the retail trader, but for FPIs when they evaluate a market.
Rajesh, we just step back and see the direction of the capital market taxation over the last couple of years, whether it's to do with STT this time, some time back it was the hike in LTCG. What does that tell you about what next, irrespective of what the intent behind it may be? But just the direction seems to be taxing more and more on capital markets.
I mean, generally, if you've seen from 2014, whether on personal income tax front, except for corporate taxes, where there are fantastic moves to bring the taxes down, on the personal taxation front, taxes have moved up. The surcharge on personal income tax is very high. The AIFs get taxed at 42%, which I think is killing that industry. So the messaging is very clear. The government doesn't think that the rich deserve any handholding, or the capital markets can be healthy on their own because of the growth that we are likely to see in this country. So I think the government is betting that 6% growth or 7% growth alone will take the markets up. They don't need any more support financially.
Yeah. Do you have exposure to any of these capital market stocks themselves, apart from your own trading, Rajesh, on the equity side?
Luckily, I'm in the capital markets. I think I don't want to add to the problems by having investing in capital market stocks. I do have NSE as a disclosure, but apart from that, I try to keep away, because if the business gets good, I will do better anyways. So I don't want to double down.
Yeah. No, absolutely. A point taken. You're already in it in that sense. Rajesh, thank you very much. Good speaking with you, and have a good day on the court. Thank you for joining us. That's Rajesh Baheti, and strong words and strong view coming in as always. Doesn't mince words. I think we've got let's just go back to the yields and rupee market, right, and see what's happening, because what's happening is, of course, yields are hardening as was expected. At the open, we got the RBI defending the currency. So that's still there, 91.78. So it's a strong open for the rupee against the USD. And in about 3 minutes' time, I think we'll have the market open as well, and we'll have the FPI sense. Sudarshan is back with us. Sudarshan, anything on your screen and 910 calls?
Well, the 910 call is HCL Tech, buy with the stop market 1610 and avoid the Nifty.
HCL Tech. Mitesh?
I'll go with the sell on Tata Consumer with the stop at about 11.10 or just above it.
Tata Consumer. By the way, look at Asia this morning. Yes, perhaps the Indian markets preempted the fall, the kind of weakness that we're seeing in Asia yesterday. But Kospi is down nearly 4%. Hang Seng is a cut of 2%. The Chinese markets are down 1% despite positive economic data coming through. The Taiwanese index is lower by nearly 2%. So across the board, there is a very sharp sell-off, a rout that you can see across the Asian market. And the mood is clearly risk off. So the question is, will that add to the negative sentiment here in India? Maybe they're also reacting to the bullion bloodbath that we've seen over the last 48 hours, with silver prices down nearly 40% from the peak. So maybe that's also, the volatility in the commodity markets is hurting the global equity markets in Asia. But I guess we've seen part of the fall yesterday.
Well, that's what, Rima, you want to tell us, earlier today we were trying to clutch into some kind of positives, and you're telling us auto sales numbers are looking more or less better. Run us through that.
Yeah, so auto sales numbers are actually pretty good. We've seen a double-digit sales growth across most of the OEMs. So in one line, the numbers are strong and the momentum has continued in the month of January. For M&M, both auto and tractor have seen strong growth. Auto sales are up 24%. For tractors, it's up 47%. Tata Motors passenger vehicles too have seen a sales growth of 47% on a year-on-year basis. For Hyundai, it's the highest ever monthly sales with an increase of 11.5%. For commercial vehicles, Tata Motors CV, it's another strong month with total sales rising by nearly 30%. Again, Ashok Leyland also seeing very strong momentum, particularly on the truck side. The total sales are up 27%. TVS Motors has had a strong month. Here, the growth rate is inching towards 30%. For Eicher Motors, 14%. And Hero MotoCorp's total sales continue to remain above 5 lakh units with total sales jump of 26%.
Okay, we are at that moment and markets opening. What do we have? First rates coming through, 60 points lower on the Nifty, 24,750. And you've got the Nifty Bank, which is down about 300 points, 350 points at about 58,071. So this is not a bad start at all, but this is just the start. We've got the mid-cap index, which is down about 45, nothing flat. Then we've got the small-cap index, which will come up. And I think you will have some change coming through there as well. Small cap index is, down about a third, 56 odd points lower. Advanced decline, 800 up, about 650 odd names which are starting lower. And lots of stocks at the bottom of the screen with regards to how they are starting up. The Nifty heat map should give you a quick sense of where we are starting. And then we will pick it up from there. Okay, heat map in just a bit. But this is a much better than expected start. But this is, the first 30 seconds that we're referring to, and you've got a full trading session in front of you, a full trading week in front of you in that sense. 24,760 for now. Nigel has walked across to the big wall. Nigel, tell us more.
Well, Nifty down close to around 50 points or thereabouts. The Nifty Bank, that's pulled back a larger proportion. I'll tell you what, that 58,000 mark is very, very important for the Nifty Bank. Yesterday, we went down to around 57,800 or thereabouts. So that's important because the 100 DMA as well comes in at that level. We've been talking about Brent crude prices cooling off. Remember, a few trading sessions ago, it went to around $70 a barrel and then it pulled back. So you have stocks like ONGC as well as Oil India. Both of them should come up for you on the screen. Both of them were beneficiaries of that move that we saw from around $63 per barrel to around $70 per barrel. Both those two have come in for profit taking today. From the Nifty pack, Eicher Motors is another stock that's opened up a little bit softish. I think the last I checked, Eicher Motors was down close to around 2%. What's opened up in the green? From the Nifty pack, you have Sun Pharma that's continuing yesterday's run, so that's well in the green. And BEL, that's the other stock, I think, from the Nifty. Sun Pharma actually has given up all the gains right now, but BEL is a stock that's bounced back up close to around 2%. The fine print indicated that maybe, in fact, the defense spend is as good as anticipated. So post bout to profit taking, BEL opens up in the green. I think HAL and BDL as well did see some kind of pullback. Bharat Dynamics yesterday ended down with a cut of close to around 10%. That's opened up more or less flattish in today's trading session. What else? HPCL. Well, that stock yesterday recovered from the day's low. I think from the broader markets, that one as well has popped up in trade. So that's sitting with a gain of another %. And the divestment target is going to be very, very important for this year. And they're projecting close to around 80,000 crores. So obviously, IDBI Bank is going to be a stock that's going to be in focus all through the year. That one's holding with a gain of close to around 1%. Anant Raj, the last time I checked, that was seeing some follow-through buying post yesterday's big move. So from the broader markets, that one is calling for attention, up close to around 4.5%, and RVNL as well from the railway pack. That stock is doing pretty well in today's trading session. So lots moving around from the broader markets, from the Nifty as well. But the good news is, as you can see, the sensex has moved into the green. You know, guys, I'm getting that feeling that it's like two batsmen moving, to chase a tall target, batting second. And you have the RBI and LIC probably that are coming in there to play a good knock today. Let's see how that goes.
I don't want to say LIC, but I think you said it, Rachel, but we'll see. You know, you got the start, which is not bad. But these things you can, markets have a mind of their own and you can kind of sort of do things for a while, but the overarching, the bigger trend takes hold sooner rather than later. For now, it's not bad. I mean, 24,782, and we're down about 0.75%. The Sensex is absolutely flat as well. Well, S. Narain is Executive Director and CIO, ICICI Prudential AMC. He's one of the largest money managers in the country. Narain, good morning. Great to have you with us here. And I should say congratulations first up on that. I mean, I think investors are going to be happy. You're going to be around at the helm of things. So it was good to see that. Narain, what's your sense? The budget reaction, and what will the market do from here? Lots of opinion that we've gotten, pragmatic, etc. But this STT thing maybe is just kind of, for now at least, overshadowed everything.
I was involved in stockbroking from 94 to 2004. Somehow I've not seen retail investors make money in derivatives, but the way markets have reacted since yesterday is as though the retail investors have made a lot of money in the last 25 years in derivatives, which has never been the case. In fact, the regulator prepared a long document showing how much money was lost in derivative segment. But the market reaction since yesterday is only to do with STT, because everything else in the budget was fantastic. Because if you look at the fiscal deficit, it is in order. Overall macro is in order. And government is thinking, how can, one of the biggest challenges for India is it was not seen as a country which is connected to AI. So they did come up with this data center tax concession to propel investments in data centers. We've always been supportive to any tech trend in IT services, in cloud services. Everywhere we've been a supporter. So I think in AI also we have to be a supporter and create an AI services boom. So I think that step was a step in the right direction. But the market is looking at an area where only retail has lost in the last 25, 30 years. And if you increase taxes there and reduce volumes there, it's beneficial for retail. They have not touched STT on cash equities. So that is the challenge at this point of time. How to convince the market that actually this is a positive step for most retail investors, bad step for HFT traders and those kind of people. So how to convince that is one of the challenges, I guess, for the government.
This, from your fixed income team, the gross borrowing number, yields are higher. Narain, any thoughts there?
Yeah. See, actually, they have budgeted for a very small number in small saving schemes. If you look at the way small saving scheme collections have been this year, it has been fantastic. So if you assume that small saving scheme collections will be very low and prepare a borrowing program, today I would say is an indicator of over worry, because at the end of the day, small saving scheme collections have been going up. And if you continue with that kind of trend, you're going to see a situation where the gross borrowing program, the net borrowing program is what matters, not gross borrowing program. And the net borrowing program is likely to be lower than what is budgeted, because the small savings scheme will take a much bigger share of the borrowing program. So while today's yield increase was something which my colleagues in fixed income had predicted, our view is that this is possibly not a score to worry, because the overall fiscal of the central government is very comfortable. It has been one of the best in recent years. And it's only the state government where we don't have complete comfort. But in central government, we have complete comfort on the way the fiscal management has been.
Got that. Narain, hi, this is Rima here. We'll get to the budget nitty-gritties in just a bit. But before that, Wanted to get your view on the ICICI Mutual Fund's decision to resume subscription in the small cap fund. This is after suspending it for nearly 22 months. So take us through that decision, and do you think small caps will start outperforming the large caps, and all those worries about the froth, has that settled?
See, we are always worried about euphoria, and we don't know how to react to euphoria because we have a comprehensive product range. So we felt that euphoria is completely off in small cap. There is no such euphoria in small cap. The euphoria had shifted to precious metals actually. And so we said that even if we open it, there is no risk of, euphoric money coming in or anything like that. From a market point of view, our view has been fairly static. We believe that most asset classes are costly at this point of time, and the only way to invest is asset allocation. Obviously, equity is a trifle more attractive than a year back because markets are down in small cap, and if you ask me, slowly the valuations are becoming slightly more attractive. So obviously you can have a slightly higher allocation to equity compared to a year back. But even today, markets are not cheap across the board. And we find it difficult to identify good thumping the table buy ideas in equity with big upsides at this point of time, even today, across market cap. But clearly the euphoria in small cap, we are far away from euphoria in small cap. If you look at the number of stocks which are touching new lows in small cap each day, it is so much higher than anything else. So we felt, as an investment institution responsible for public money, we thought the time for closing the scheme is over because there is no longer any euphoria.
But it's not a signal, Naren, right, that you are now gung-ho on the small cap space. And I mean, say if you get an inflow of 10,000 crores in one shot, will you deploy immediately? Because you're seeing those kind of I mean, it's a theoretical question. I'm exaggerating to just make that point, just to get that clarity.
We are not gung-ho. We are
no, in that space, in small caps.
We are gung-ho on areas like specialized investment funds, for example. We are gung-ho on asset allocation. But these are all more defensive ways of investing than pure equity at this point of time. And that is what we have been trying to do at this point of time, that where we are gung-ho, we try our best to collect money. But and that is the situation. For gung-ho, you need lower valuations. There's nothing wrong with the macro. There's nothing wrong with what the government could have done in the last 1 year, like lower GST, lower interest rates, etc. But the fact is valuations are high. And even today, many of the companies are able to easily raise money even if the valuations are high. So we're not yet in that gung-ho moment where we can say invest all your money in equity. That kind of situation we aren't in.
So that small cap signal is basically getting ready for whatever happens, right? I mean, that opportunity whenever it comes
Exactly.
up. Okay.
Exactly. And there are investors, who wanted to invest more than the amount that we had specified. And we said that it was proving to be a bit difficult. And that was the reason why we said, let's open. There is no gung-ho moment.
Okay, hi Naren, good morning and good to see you. When 2 years ago, when you took that bold call that precious metals was the way to go, when there was euphoria playing out in small and mid caps, that was bang on. Current asset allocation, how does it change things? Given that small caps have gone through a big price correction and large caps have gone through a time-wise correction as well. So give us the strategy right now. And also with regard to metals, precious as well as industrial metals, how far away are we from that peak or euphoric stage?
Clearly we are in euphoric state. The only challenge is that how do you value precious metals? See, when you look at equity market, there's a value. You look at price to earnings, you look at price to book, you look at ROE, we look at market cap, etc. How do you value precious metals? But purely from a behavioral point of view, we are seeing euphoria in precious metals. Honestly, we don't know how to value precious metals, but we do know that it is the riskiest asset class at this point of time. So we tell people, if you want to put money in precious metals, do it only through the multi-asset route. Because whatever we have been seeing in the last few months is completely euphoric. The challenge is people want us to get the top exactly right. It is hard. It is impossible. I mean, it is impossible for us to get into a euphoric framework when that euphoric top will be exact price and then come. Our experience of 2007-8 was when something becomes euphoric, you decide to become cautious irrespective of how much more it will go. And that has been our framework. So over the recent past, we have been continuously telling people don't invest standalone in precious metal ETFs or fund of funds. Focus only on multi-asset so that you're not investing big money in precious metals at this point of time. A framework that we have is that whenever any asset class gives you triple-digit return, that is more than 100% return, that in a year, you have to be careful in that asset class, and that asset class is silver at this point of time. So that's what we've been trying to do, but people want us to guess correctly an asset class which can never be guessed correctly, because you see the daily moves in silver, you know it is impossible for someone at ICICI Prudential to guess daily movements in silver, which is a global commodity, and how it will move up morning, evening, night.
No, absolutely. Because, I mean, I remember, Naren, we spoke last time. This was in the new year. I mean, I think the first couple of days of the new year. And you said, well, I think that shift has you looked at ratios, etc., right? I mean, Nifty to gold, Nifty
exactly.
to... And that had moved too extreme. And you said, well, now it's time to kind of split back to equities because it's just too extreme. And as you said, right, it's tough to call the top because then after that, I mean, prices ran up, gold and silver. And then, I mean, and then they've corrected, right? Very, very sharp corrections last Friday and today. I mean, we're seeing the prices correct today as well. But if you had to take a call, I mean, broadly, not exact or anything, have they topped out for now, especially silver? Silver is the more violent and volatile kind of...
That is what we think. That is what we think.
Yeah.
But can you get it right? That's a question. It's a global commodity. Yeah. Maybe Chinese can decide. I don't know who's going to decide. If you ask our view, yes. And we have been telling people don't invest in silver ETF or in silver fund of funds for the last few months. And people tell us you're bearish. What to do?
So this is
part of our job.
Yeah. If you look at long-term price charts of silver, there is they kind of it does things like what it has done recently. And then for years, it kind of goes sideways. Are we in for something like that? I mean, have you looked at that? Any thoughts, Naren?
We are not experts, but how do you, if you look at Nifty to silver or Nifty to gold ratio, clearly we won, particularly last week, it was clear that one should not invest in silver and gold. People should take out money from silver and gold and put it somewhere else.
Naren, one of the reasons that FIs have given a pass to India despite the expected earnings recovery is that even though in India, say FY27, we get about a 13% kind of earnings growth, you're still getting a 15 to 20% earnings growth expected, say, in emerging markets or even in the broader US markets. So those markets are still attractive. Now that even the budget has not given any concessions to FIs, what is the expected FI behavior to your mind this year?
So why did they invest in earlier years like 2024? So what happens is, we've seen in those years, they were not willing to invest in Brazil and China, which was very cheap at that point of time. And they were overweight India at that point of time. Our view is that, recent past performance does play a role in deciding where money goes. And if you look at India from a one-decade view, I think India represents one of the best structural stories. The challenge for us is particularly people who have been fund managers for long as the markets have not been cheap. If by chance the markets have been cheap, we would want to give a thumping the table buy on equity because everything else is in favor except valuations. And that is the challenge we've been facing. And that's why it's boring for us to tell every time, do asset allocation. But that's what we have been forced to do only on account of valuations. But today valuations across the world is not cheap. And that is why I do agree in the very near term, maybe there are AI stocks which will deliver very good earnings growth, but neither are other markets cheap at this point of time. So I would say that to be maximum underweight today in India at this point of time means that at some point of time in the future, they will have to think of buying. So that is a positive in my opinion.
Naren, do you have a view? I mean, I remember speaking to you on the sidelines of the Global Leadership Summit late last year. You said the big risk for market is this AI thing bursting whenever it happens, right? Any thought, any updated view on that? Will we see a shakeout at some point? Are we there yet?
Yeah, clearly, I mean, when you compared AI and precious metals, I thought precious metals had become much more euphoric than AI. If you look at AI, at least many of the stocks had stopped going up in a parabolic move. So, between AI and precious metals, we had to, we always look for the most dangerous areas. So the most dangerous areas in the last 1 month turned out to be precious metal. It is not that AI is cheap. I think AI has still got to go through a correction, but AI is not at this point of time in bubble. It may be extreme valuation, but at least it is not a bubble. And I would say that there is a good room for a meaningful correction in global equity markets. But how much knowledge do I have when I make this statement is something I ask myself. But if I just do simple calculations like market cap to GDP, I think there is scope for a meaningful correction, but we are not experts. And therefore, we believe that if the global equity markets correct, our view is yes. And if they do, I think India should outperform at that point of time. But there is a risk of a global equity market correction in the next 2 years. When it will happen, again, we don't know. It will be nice to know if we could correctly time it, but we wouldn't know.
Okay, all right. Thank you very much for that. Really appreciate your time, and thank you for joining us with that perspective. That's S. Narain with that perspective. Well, Neelkanth Mishra is with us, Chief Economist, Axis Bank and Head of Global Research at Axis Capital. Now, if there's one voice that people want to hear after a budget, any budget, at least the last decade and a half, is Neelkanth. Neelkanth, I can tell you, once the budget is over, everyone is scrambling to find details to your post-budget call and the note later. So tell us, Neelkanth, what's the verdict? There has only been 3 alphabets which have been talked about very much. I mean, Naren did not do it, but it is STT. What are your headline thoughts? And then we'll dive in.
So the headline thoughts, the first is that as expected, completely predictable. And I think that's a good thing. I think having predictability allows businesses and investors to plan ahead. There are no shocks. There are no dramatic changes in tax rates. The spending quality continues to improve. There is no attempt at wasteful spending, and allowing more money to go into the hands of the private businesses and investors. The challenge that I see, I think the STT issue is more for controlling speculation, as the finance minister also mentioned in the press conference. But the challenge, I think, is on the financing side. So you've seen that the 10-year bond yields have now gone up to 6.76. And clearly the financing plan for the deficit and the fact that the government's overall conservative approach to forecasts, so taking a 10% nominal GDP growth, taking tax to GDP only marginally higher, I think they can do better on taxes. Perhaps on the financing side, they've gone excessively conservative. And that's something that is having the opposite effect of what the fiscal discipline and sticking to the fiscal consolidation path should have achieved. So there's clearly some work to be done there. I think 10-year yields should be, closer to 6 and not 6.76 is my view, because the liquidity conditions are such that banks are having to borrow 12-month money at 7%. Yields have been going up, and now with the gross borrowing coming up higher than what markets had expected, has again started to push up. So that's something that I would say is perhaps the only niggle. Maybe you could have also expected a better plan for privatization and disinvestment. But again, some of those things can happen during the course of the year.
Neelkanth, are you saying the government has been very conservative with the revenue collection targets, and that is actually that's not the right way to look at it? So you're telling markets don't be worried because they've been too conservative and they'll collect more. Is that what you're saying?
Part of it is that, but I think the bigger issue has been on the financing of the deficit. So, for example, if you take small saving schemes, and I know we are getting a bit nerdy here.
No, because Naren just talked about exactly that, the small saving schemes. It's been very healthy, but what they've accounted for is very conservative. Yeah, go on, sorry, Neelkanth.
Yeah, exactly. So, sorry, I only caught the last bit of Naren's talk. So the first 9 months, there is a 32% increase in collections. But the full year number for FY26 is down 13%. So I think 4.2 lakh crores in FY25 falling to 3.73, something like that in FY26. Whereas in the first 9 months, you've seen a 32% increase. Now, a large part of the small savings inflow actually happen in the month of March. So perhaps they know more than what we do, though it seems unlikely given that there's been no dramatic change in the policy of other rates on small savings schemes. And on that low base, they're expecting a 4% increase next year. Now, this is very good and conservative because, frankly, predicting some of these things is hard. But this means that you are expecting, 1 lakh crore, 1.2 lakh crores less on small saving schemes, and potentially even 1.5 lakh crores less than the small saving schemes than what you're likely to get. And this is possibly why your cash balances, meaning government cash balances, which can go out of the banking system and therefore bring down the quantum of deposits available for banks. So, the conservativeness on this front, look at government cash balances. They used to be 0.5 to 1 lakh crores for on average till the single nodal account transition happened about 2.5 years back. Now they are averaging 2.5, 3 lakh crores. Now, this is money that is effectively, not available for banks to lend with. And having this disruption for a while is understandable. But now it is starting to have a counterproductive effect that despite the fiscal discipline of the government, the 10-year yields are actually going up. I mean, that needs to be addressed. I think it's between the RBI and the government. But as I said, this is a technical operational problem. I think the hard miles on fiscal consolidation are now behind.
But you expect the yields to inch lower. It will be addressed from the current 6.76. You said ideally it should be 6%. And if it stays around the 6.5%, 6.6%, what are the broader implications? Will it hurt the growth? Will it impact the kind of earnings expectation the market has, investors have from the market?
Absolutely. So, see, look, the fact that the core inflation measures, ex gold and silver, plus, say if you take median inflation, those measures are at record lows. There is clearly evidence that there is significant slack in the economy. Now, the economic survey talks about 7% growth being the trend growth, which I think is the right measure that we have been at that level for a while. And if you assume 7% growth and assume that the starting point is say FY18 or 19, we are 10% below where we would have been if COVID had not happened. And so therefore there's significant slack in the labor market, in the economy. Now there's significant output gap. There are only two ways to close an output gap. One is fiscal, the other is monetary. Now on the fiscal side, I think prudently the government is sticking to its roadmap, which means that interest rates and cost of borrowing should come down. So it will take much longer if we are not able to cause this transmission. It will take much longer to close that gap, and therefore there is definitely an impact. Part of the reason the banks sold off so much yesterday, I think, was while on budget day and there's so much of futures and options volatility that's very hard to pinpoint reasons. But I think this could be a reasonable driver of that decline. That if your cost of financing, cost of funding is going to stay elevated, irrespective of whatever the RBI may be doing with the repo rate, it's a challenge.
All right, Neelkant, final question before we let you go. The big push for data centers, that could yield quite a few dollars and quite a lot of inflows. What's your take on that? How big an opportunity is it? That's one of the positives from this budget.
Look, the commitments from Microsoft, Amazon and Google, the three major data center providers, I think the others like Oracle haven't yet made announcements for India yet, together are already about $75 billion over the next 4 or 5 years. That's quite substantial. My understanding of the tax cuts, though, I mean, this is more my guess on the possible reasoning behind this change, is less to make India host data centers for the rest of the world, which frankly is also not a bad idea. But a lot of that competition is about the price of land, the price of electricity, basically energy costs, the price of water. A lot of those things go in. And remember, we are competing with space here. So there are people who are now arguing how the space may be more effective. The reason why perhaps this has been done is that suppose you have a global firm setting up operations in India. There is a data localization drive within India as well. And they can't just do it for India. So suppose that, that same setup needs to service some other country as well. In that case, the taxation should not be adverse. And I think they just clears up on that. And therefore, whatever investments may happen in India to meet India's demand, and the data center may not have been, the demand may not have been sufficient to set up everything here, and you want to do some bit of global servicing from here, I think that gets addressed. So this, I would say, is more an enabling factor than a big driver of investment by itself, because that competitiveness will come from cost of energy, cost of water, cost of land, and things like that.
Okay, all right, Neelkant, thanks a lot for joining in and giving us your take on the budget. We look forward to chatting up with you rather soon. Well, time to welcome next corporate then. We have Cholamandalam, which is the next management on the show. The loan growth disbursements came in healthy. The net interest margins expanded as well. We have Arul Selvan, the president and CFO of the company, who joins us on the show. Hi, sir. Good morning. Thanks a lot for joining in. Well, give us a couple of data points then. With regard to the disbursement growth, you were indicating that it should pick up in the second half of the year. So what is the outlook now for the year on the whole? And also, what does that mean in terms of AUM growth?
We stick to our original or the earlier, indications. You've seen that happen in Q3. Q3, you saw the disbursement grow by 16%. And just like how the AUM did not move much when the disbursements plateaued, same way immediately it will not move much, and so AUM remains at the 20% growth levels which we have indicated. It will remain so in in Q4 also, while disbursement will pick up in Q4 further. So we see better disbursement numbers in Q4, but it will also not immediately reflect on the AUM. AUM will still grow at the 20 to 22%, which we had been indicating.
Okay, and the disbursement growth, sir, I missed that number.
So disbursement growth would be similar at around 15 to 16% levels in Q4 as against previous Q4, but overall disbursement growth should be in the range of around 10 to 15%.
Got it, sir. All right. Your NIMs that you've reported, actually, they have increased by close to around 10 basis points. That's something that you were guiding for. It's got a bit of an improvement, I think, in the home loan part of your business as well. What's the outlook with regard to your NIMs from year on? And how do you expect your cost of borrowing to pan out in the coming quarters?
The cost of borrowing could improve further by around 5 or 10 basis points, and that should reflect back into the NIM. We will see the similar levels of NIM levels as we move into Q4, because the shorter end borrowings have sort of tightened, so there has been not that much savings out there, though we don't really do much of the short-term borrowings. So we don't see that impacting. However, we will be cautious about committing further on the NIMs. So we stick to our 5 to 10 basis points improvement in Q4 as compared to Q3.
Got that. Your vehicle finance segment, I was just seeing the internals grew at 17%, which is lower than the overall AUM growth. Can you explain that? Because CV markets seem to be doing very well. So, what is the expectation, particularly on the vehicle finance business?
Vehicle finance will grow better in Q4 from a disbursement perspective, but the reflection of the same on the AUM will still be little muted because it's a very large book. So one quarter disbursement may not shift the AUM growth that much significantly, or instantaneously. So you will see that growth more moving up progressively rather than having a visible impact immediately for a single quarter's move.
And for vehicle finance, what is the disbursement growth that you expect in Q4?
We expect around the same 16 to 20% growth in Q4 because last year Q4 would also be a better quarter. So we do not want to look at it from current quarter versus this next quarter.
Okay. And credit cost was at 1.7%. In Q4, do you expect it to decline?
Yes, it will decline in Q4, and the overall full year credit cost should be in the range of around 1.6%. This is what we have guided earlier also. We stick to that. We will see reduction in the unsecured book happening. You are already seeing that happening in the quarter-over-quarter numbers. So say this will further, benefit in Q4. And vehicle finance, always Q4 is a good quarter because that is when there is a lot of money with the borrowers because of the harvesting, etc. So that should also augur well for the loan loss numbers. So overall full year, in spite of the first 3 quarters being in the 1.8, 1.7 range, we still see a 10 basis points improvement when we close the full year.
Okay, final question before we let you go, sir. The ROA is currently at around 2.4%. Do you expect it to hold on to these levels? And what are the levers you have in store to see some kind of improvement in the coming fiscal?
So in the coming fiscal, we will see the full year's benefit on the cost of fund happening. The other thing is that the products which we are now growing are of a higher yield, like gold and even CSEL, and even the corrections which we did in SME, etc., should augur well in improving the bottom line, and so that should help us to improve the return on assets. And at a PBT level, I think we should be much closer to the 3.5% pre-tax ROTA levels, which we had always been working towards, and I think we should reach that in FY27.
All right. Sir, you're often compared to Shriram, and they've had a massive equity infusion post the partnership with MUFG. I mean, how has it changed the competitive dynamics? They've got a rating upgrade as well. And are you looking at any sort of, a similar partnership or an equity infusion?
No, we are not looking at partnership per se, but over a cycle as our, Tier 1 capital proportion, if it scales down below a threshold which we have set internally, we will certainly be open to taking fresh equity. But at this juncture, we are not looking at any partnership because there is a good amount of promoter interest and they continue to be, looking at Chola as one of the prime investment or their holdings. So we'll continue to be in that same position.
Okay, all right. Pleasure speaking to you, sir, as always. AUM growth of more than 20%. NIMs could improve by around 5 to 10 basis points from year on. And credit cost comes down to around 1.6%. Appreciate you joining in. Look forward to having a chat with you as the quarter does progress. Well, before we slip into a short break, there's news that, in fact, the Nifty is now at the high point of the day. We're up close to around 80 points. And there is further strength being seen on the Indian rupee, which is now pulled down to around 91.55 or thereabouts. Both those two doing pretty well this morning. Time to slip into a short break. On the other side, we have Rhythm Desai, Managing Director and Chief Equity Strategist, India at Morgan Stanley, who's waiting for us. Stay tuned.
Welcome back. Markets pushing higher now. 24,900 crossed on the Nifty. The sensex has moved up by nearly 400 points. So after slipping 1,500 points yesterday, at least the markets are trying to recover. Asian Paints is your top Nifty gainer now, 3% up. We've seen a seminal fall in crude prices, so that is providing a relief. And Asian Paints has had a rough 2026. The numbers were disappointing with their volume growth, and plus crude prices were inching up. L&T is the other big mover, nearly a 3% gain on that. And then you've got Reliance Industries. That's really fighting for the bulls. Along with that, HDFC Bank, ICICI Bank are moving up 1%. Defense is also broadly higher. But let's invite the management of Dixon on the show now. Saurabh Gupta, Group CFO of Dixon Technologies, is here with us. Thank you very much for joining in. Saurabh, so just for the budget for your company, we've seen an increase in the overall EMS outlay for EMS to 40,000. But then mobile PLI, which started in calendar year 2026, had a 6-year clause, so it was ending this year. Has anything come on the budget with respect to mobile PLI? Tell us that first.
Yeah, hi, good morning. Thanks for having me. So as of now, I think so the government is very much deeply engaged with us, with the industry. Now, to say with absolute surety whether the mobile PLI will get renewed or not, it's very difficult. But clearly, we feel that the government wants to provide support to the sector till the time the component ecosystem gets created. And clearly, the allocation towards the component scheme has been increased to 40,000 odd crores, which is clearly a pivot towards more and more component localization. So very difficult to say, Rima. Yeah, but in this budget, there was no such announcement on extension of PLI. So can't say for sure whether it will get extended or not.
But you were a big beneficiary of this mobile PLI over the last 6 years. So the fact that it's not happened in the budget is an overhang for now, because there's still no clarity if it'll come through. I mean, how does it impact your business if it doesn't happen?
So Rima, we have been investing in backward integration. So we are investing in the camera modules. We are investing in the the display panels, display modules. Some of them will go live by Q2 of this financial year. Camera modules, we already acquired this company, and we've already given a indication to all our investors that, of course, 26-27 will be more of a stabilization year, but 27-28 with this kind of backward integration that we are planning, we feel it will really create a lot of strength and moat in our business, and it will be really margin accretive for our business. So we should be able to overcome the PLI impact very soon, assuming the PLI doesn't get extended.
Oh, okay, all right. So we'll have to wait for clarity on that mobile PLI front, and that's something that the street is a little bit cautious on as well. But sort of let's focus on a couple of other key factors. What about the Vivo approval? That was scheduled to come in. That's got pushed back a little bit. Could you tell us timelines on that front?
Yeah, Vivo, we feel that the approval should come in very shortly, very soon. Now, very difficult to give an exact timeline to it. We are in very deep discussions with the government. We are deeply engaged with the government authorities, and we see no bottlenecks. It's only a question of timing, but we feel very confident that the Vivo approval should come in.
Okay, because does that put a risk to your volumes for the next year? How do you achieve that guidance? If you could help us out with some volume guidance for the next year.
Nigel, for me to give any volume guidance in mobiles is very difficult because the memory prices have been going up. And now it's a question of availability of the memory prices. Even the brands are not able to give us a complete visibility. It will take some more time. But clearly, we feel that the Vivo approval should come in. And also, we feel that even the other brands, there should be some growth. Our existing brands who we are manufacturing. And apart from mobile phones, of course, the other sectors, other verticals for us like IT hardware, telecom, refrigerators will have a very strong growth.
Okay. Saurabh, I wanted to ask you about memory prices. Morning.
Morning.
Absolutely crazy, right? I mean, look at what... I mean, if you are in one of these names on the other side, Micron and all these other stocks have gone berserk. So there is like lack of availability now. I mean, it doesn't make sense, right, at these prices?
Yeah. So there's lack of availability. The capacities are limited. Capacity generally takes a couple of years to come by. More allocation is being done to the AI-based application because there the margins are much.
So can you give us a sense of where prices are, what you bought at, say, one year ago? I mean, just to compare, the dramatic rise.
So the prices have almost doubled, Prashant, and especially it impacts the low end and the medium end smartphones. Not so much in the high end smartphones because the price elasticity is not that much. The customers generally don't think much by buying a high end smartphone, but definitely it impacts the low end.
And how much is it as a percentage of, say, a low end smartphone?
It will be almost it will be almost 12 to 15%. So if suppose it's a 6,000-7,000 rupees smartphone, and if the prices increase by say 1,200-1,500 rupees, so definitely we feel that the demand will get impacted, and depending on how much the brands are willing to absorb and how much they're willing to pass. So clearly the last quarter 3, there was a 7% degrowth in the market. So this is something I think so one is a key monitorable for the next few months for us.
So if a phone was 6,000 rupees, this was about $900. I mean, the cost of memory.
Anywhere between 900 to 1,200 rupees. So
and that has become double now.
Yeah. So that is further increase. Yeah, that is and continues to increase. Yeah.
Continuous increase. It's a issue which I think companies across the board are facing on the electronic side. We'll leave it there for now. Saurabh, lots to talk more, and we'll invite you back. Thank you very much for joining us here this morning with that perspective. Well, I think we're going to talk about the bond deals and what's happening there. You heard from Naren and Neelkant, both basically talking about that gross borrowing number and the conservative revenue collection estimates, small savings schemes, etc. Lata, of course, has been talking to a range of market participants. Lata, tell us.
Well, first up, let's discuss the rupee. It's stronger against all expectations on a day when actually the dollar is stronger versus most other currencies. This is because dealers tell us that the Reserve Bank intervened rather, hugely in the NDF market, which opens before our market opens. The idea being, and that's usually Reserve Bank's logic, to ensure that there is no speculative attack on the currency because people have some narrative to sell. And, if actually FPIs come and, start buying dollars because they're selling equities, then usually RBI will withdraw. But at the moment, at least the way the stock markets are, it doesn't look like there is heavy FII buying of dollars. And therefore, the Reserve Bank may have guessed correctly. We'll have to wait and see. If actual selling of equities and buying of dollars by FPIs comes, usually the Reserve Bank withdraws. It doesn't stand in the way of fundamentals. But early days yet, at the moment, the Reserve Bank is holding up the rupee. On the bond markets, very clearly, it is as expected. I mean, the market was not prepared for a 17.2 lakh crore, gross borrowing for next year. The number our own poll was 16.2 trillion, exactly 1 lakh crore less. And the average in the street would have been 16 to 16.5 trillion. And therefore, this is, getting adjusted to the fact that there will be a lot of demand. The dealer guess is that Reserve Bank is also intervening in this market. They often do, secondary market, purchases and sales. And at the moment, they must be purchasing in the secondary market. It is not at all unusual. The market is not all out selling off bonds. There is a niggling expectation that some buyback or some switch will be announced by the Reserve Bank. And in the very least, a further OMO could also be announced, but they are banking on some switches and buybacks to be announced in course of time. So it's not all hope lost, but clearly today traders are making it very clear that they don't like the borrowing program.
Yeah, no, absolutely, Lata, no doubt about it, right? And this is an issue which we will continue to discuss, debate. By the way, Hormuz is telling us that there are headlines, I think, coming on Bloomberg. South Korea has halted sell orders for program trading in Kospi. If you can just quickly look at a snapshot of Asian markets, Hong Kong and China and Korea. Korea, of course, was the top performing market in 2025, started 2026 in an absolute roll. And what's happening there? There are pullbacks, but remember, these are all markets which have done extremely well, especially on the tech side. And Korea, of course, was, the absolute king in terms of Asian markets. Can't call it an emerging market. Korea has done about 3.7, 3.8%. Taiwan has done about 2%. So it's actually a pretty poor global screen at this point in time.
Is this the trigger, Prashant? Is this the trigger for Indian markets? All those that were participating last year, suddenly they start giving up, and then India becomes a relatively better place to hide, or you don't think so?
I don't think so, Nigel. Look, first leg, you will participate on the downside. And I think, as Naren said, all other factors are okay, but it's not as if valuations are like a screaming buy.
Yes.
So when you are using other markets because they're looking too expensive, and then you want to buy something, you'll buy something which is looking very attractive. It's possible that in some of the other markets which have got this AI trigger, etc., if prices correct sharply, it could work the opposite way. People look at that as an opportunity. Oh, we couldn't get in. Yeah. There's too much FOMO, and prices are now fallen. So, The only thing is valuations here, which have corrected, which have become much more reasonable.
I was in fact reading a note earlier today that I think the S&P itself, S&P 500 is trading, I think, around 28 times, 27, 28 times. And historically, you have not made much returns from there as well.
Yeah.
So I think the risk of the global market coming off, that's another global factor at play. We have only been focusing on a domestic term. So
absolutely. I think Nigel, Microsoft reported, Apple reported numbers last week. iPhone sales was super, right? Apple did not go up. I mean, these are all small signs, but it struggled. Yeah. And I think usually you would have seen in other previous quarters, etc., with the market doing what it is, the stock doing very well. I just want to quickly also highlight oil, which is down 4.5%. Let's just look at Brent oil prices. That is unambiguously positive for a large importer like India. And I think names like BPCL, IOC, HPCL, they're all doing well. Brent is down, 4.5%. And the news report is that President Trump is essentially signaling that he's open to talks with Iran. Remember that Armada, as he called it, described it, fleet of U.S. vessels, fighters, destroyers, etc., surrounding, essentially all in the Persian Gulf around Iran. That was the headline for the last 2 weeks, that at some point this is going to lead to escalation. But I think headlines now coming in that there's going to be talks and that's the interpretation, no fighting in that sense, and the supply, etc., will not be disrupted. So it's a big move coming through right now. And BP, let's just look at BP, HP, IOC. It should show up there first. And elsewhere later, it's flat. Okay, HP is up 3.5%. BP is not. And I think IOC is the other one.
For HPCL, BPCL, the other positive is also that the excise duty was not hiked in the budget.
Remember, but I think that is, I'm not sure. That
Can
the excise, it's not happened now.
It's not happened in the budget.
It doesn't, but it doesn't happen in the budget, right? It comes out outside the budget. 16% growth in excise collections. It's got to come from somewhere. So that I'm not very sure, but I think this one, of course, is directly related to the oil price thing. We'll take a quick commercial break here. Manisha will be with us. It's all commodities, right? Silver, gold. There's another sell-off which is ensuing in global markets on the other side.
Welcome back. 100 points gone in the Nifty in a matter of 15 minutes. The Nifty is now back at 24,800. But a segment that's been far more volatile is commodities. And over the last 48 hours, Manisha, the direction has only been southwards.
Oh, yes. Volatile upside and volatile downside as well. So when you look at the gold, silver, copper, all of those metal prices, after that very sharp decline that we saw on Friday, you are looking at some follow-through selling coming in the Asian markets right now as well. I'll start with gold, and this was the biggest one-day decline on Friday that we saw since 1980. It was down by 17%. It's trading down by 5% right now as well. But I want to show you on what we've done really in sense of prices. We started January at 4,330, and then gold saw an all-time highs at around 5,600. Today, we are trading at around $4,700 an ounce. So we still are positive in the year, but from the all-time highs is $1,000 an ounce of a decline that the gold prices have put out. Silver saw 36% of a decline on Friday. Biggest one-day decline ever is what that commodity gave you. So we started this year with $71 an ounce. We saw an all-time high of $121 and currently trading at around $80, $83 an ounce. Still higher on a year-on-year basis, but from its all-time highs, it has been a one big decline that silver prices have given you. Let me take you through copper as well, and it's 11% down from its all-time highs for this one as well. Started the year with 5.6. 6.5 was an all-time high, trading at 5.8 at this point in time. The profit-taking has come in from all sectors, from COMEX, from London, from Asia, from Indian markets, and the kind of froth that was building up in China also seems to be getting away in some sense. So the major reason for decline clearly comes in, one, because of profit-taking. The speculative trade, institutional retail trade was just getting very, very overheated. The second point has been about the dollar index. From a 4-year lows, well, that one has seen a jump up. And two reasons for that. One, it is about Kevin Warshaw's appointment as the next Fed chief. He's seen as hawkish but not very aggressive, is what perhaps has been supportive. The second thing has been about the Japanese PM statement, which says that they do not mind a weak Japanese yen because that supports countries' exports, has also supported the US dollar in turn. The third thing has been about the margin hikes that we've seen on CME. huge, humongous margin hikes. Well, actually, if you wanted to trade gold and silver in India, you have to pay margins anywhere between 50 to 65% on the higher side. So weak hands, smaller retail, all of that is getting out of the market and can be seen in sense of prices as well. If you look at the metal prices on a week-on-week basis, everything is in the red there. So you have gold, which has declined by 6%. It is the PGM metals, which is silver, platinum, palladium, which has declined quite sharply. So 22, 25, 27% of a decline is what we are working with silver, platinum, and palladium. It's off to all-time highs coming in for many of the base metal prices also. So when you look at copper, nickel, aluminum, zinc, we are down anywhere between 2 to 8% for these as well. So copper and tin hit all-time highs. They're off those kind of highs by nearly 10 to 12%. We saw nickel prices trade at a 19-month highs. It has declined nearly 20% from those highs. And then you have aluminum and zinc, which hit 3-year highs. Well, they are trading off those prices as well, with the markets believing that the profit taking is not done, and you could be looking at some declines continuing today.
All right, thanks very much for that, Manisha. That's commodities, gold, silver, and of course everything else which is happening. I mean, it's suddenly a very, very macro-ish kind of a market, right? With everything which is going on. A frenzy and a bit of an unwind of the frenzy is what's happening. There's news on the bottom of the screen with regards to Lupin, and this is with regards to tuberculosis and other microbacterial diseases. So there's a partnership which has been announced. Let's just take a quick look at the market, right? It's basically given up gains. The high today is 24,940, and we are about 60 points off that day's highest level at this point in time. So market breadth is flipped. If you look at an NSE advanced decline ratio, it's 2 down for every 1 stock which is higher. And guess what? It's once again, and we'll put this up, it's silver B, silver ETF, you know, it's basically gold and silver ETFs, which are down anything between, I think gold ETFs are down less, 4%, 3%. Silver ETFs, because of the international price decline that Manisha just spoke about, are down another 10, 11, 12% or so. Actually, the first 10 quotes with volumes is all this gold and silver business, which is selling off. I mentioned oil prices down sharply, and of course the IOC and HP going up. But the explorers, Oil India, is going the other way. Oil India is down 4% as we look at it. Time for a quick commercial break here. We'll come back in just a bit from now. Lata will be speaking with CNBC-TV18's Citizen MPC ahead of the monetary policy outcome. Stay tuned. That conversation coming up next.